Good morning. Okay, welcome to our class. So we do pick from where we did review yesterday. Okay. And yesterday we were discussing on the procedures that we can carry out as an auditor with regard to the audit of inventory. With regard to the audit of inventory. Okay. And we said essentially when it comes to the audit of inventory, just like the same way we did with the audit of the non-current assets, okay, we say that, of course, you need to begin with the financial statement assertion in mind, okay? So we begin off with the financial statement assertion, okay? And of course, for each of the assertion that you will be having for that particular account, okay, of course, you discuss the substantive audit procedures that you'll use in order to test as to whether that particular account, that particular assertion, okay, is to present a fair and a truth, okay, it is truthful, more or less, okay. Okay, we discussed some of the assertions, okay, that we can carry out as an auditor, okay, we discuss a number of them. We discuss on the existence as well as the occurrence. Okay, existence applies to the case of the balance sheet. Occurrence, of course, applies to the purchase and sales as well as any write down that may necessitate. Okay, when it comes to the audit of inventory. We discussed on the completeness. Okay, discuss on the rights and obligation. Okay. Towards the right is that we need to ascertain, okay, as to whether the company has the right to the receipt of any potential future cash inflows from that particular account, okay. Obligations, okay, we did discuss that sometimes company can have obligation in terms of warranty, okay. We have a scenario where there's a warranty. So just in case there'll be warranties, okay, or maybe just in case there will be damages in future, okay. So the company has an obligation either maybe to replace that commodity or either to make good for the damages of that particular commodity. Okay. So in that case, therefore, it's worthwhile for the company to quantify, okay, any potential warranty obligations that might arise in future. Okay. And I think today we discuss on we discuss on accuracy. Okay, today we did discuss also on valuation. Okay, we did mention on valuation. Okay, on valuation it was simply trying to assess what value, okay, should be appearing on the financial statement. Okay, in case there's going to be write down. Okay, how do we go about it? Okay, we say that the ISA, the reference ISA, the reference IS we shall be using. Okay, is IS 10, no IS 2 on the inventory. Okay. And we say that when it comes to valuation, okay, don't forget you have to pay attention to what the IAS is telling us. Okay, when it comes to valuation, it's law of cost and NRV. Okay. So today I want us to discuss on the next assertion. Okay, that is on cutoff. Okay, because the last thing we discussed was on valuation. Okay, so today I want us to discuss on cutoff. Now on cutoff, don't forget when it comes to the inventory, okay, we would want to ensure, okay, we would want to be confident, okay, that all the different purchases that were made as well as the sales that has made out of the inventory, okay, that they have been recorded in their correct account period. Okay, don't forget cutoff simply means that you're going to be having the different, okay, transaction, okay, recorded in their correct account period. Okay, if a transaction occurred in the month of January, then it ought to be recorded in the month of January. Okay, if a transaction occurred in the month of February, it ought not be recorded in January, but it ought to be recorded in the month of February. Okay, so cutoff is more towards the accounting period, the accounting period. Okay. Of course, as part of the company internal control, one of the ways they can ensure that they do have cutoff. Cutoff is being used. Okay, is by closing off what we call the accounting period. Okay, if in the month of January, okay, we need to close off that particular period. Okay, to an extent that we do not, okay, have someone who is going to let alone post in that period. Okay, so in case we're in the month of February. Then essentially by the 10th, okay, or maybe by the 15th, no, the other 15th is too much, okay, by the 5th or to the 10th of month of February, okay, we ought to close down the previous month, okay, so that we do not have a scenario where we are in the month of March and the accounting period for the month of January is still open, okay, to an extent that someone can post entries in the month of January, okay. Either way, in relation towards the inventory, how do we ensure that the company has done that? Okay, that they have put in any transaction, okay, purchases as well as sales, okay, in their correct accounting period, okay. One of the way is you can check on the GDN, okay, or for what was a good dispatch note, okay. So GDN here implies the good dispatch note, okay, that implies the fact the company has made a sale, okay. So they're going to be over and above sending the invoice. They do also have a GDN, okay. So one of the way that you can carry out, okay, is note the numbers of the last GDNs, okay? So if, for example, we are in the month of April, okay? If, for example, we are in the month of May now, okay? Essentially, the GDN, okay, we need to go to the books of the company, get to note, okay, for example, what was the last GDN, okay, what was the last good dispatch note, okay, that was processed in the month of April, okay, that was processed in the month of April. Now, if the GDN, okay, let's assume that the last GDN to be processed, okay, was number 10, okay, was number 10. Then we need to go to the company accounts, okay, try to see what was the last sale, for example, that was recorded in the month of April. Now that GDN, okay, ought to match with that sale that was made in the month of April, the last sale that was made in the month of April. If that doesn't happen, or if that GDN was recorded in the month of May, then to me, therefore, we have a cut-off problem. Okay, to me, therefore, we do have a cut-off problem. Okay, which implies, therefore, the inventory balances most likely. Okay, there's a misstatement in terms of the accounting period in which they're being reported. Okay. When it comes to the GRN, okay, the good received note, okay, the good received note, okay, the same thing is going to apply, okay. That's essentially we may need to assess, okay, check whether, okay, that the GRNs, okay, that you have received, we have received some of the, we have made some purchase, okay, we have made some purchase from our supplier, okay. Of course, the suppliers will also over and above send the good, okay, over and above send the good, okay. They're going to have the invoice which have received from supplier's invoice plus the GRN, okay. Of course, supplier wants to know that did you actually receive that commodity, okay. Of course, they're going to ask you, okay, sign here that you have received this particular commodity, okay. So there will be a GRN plus, of course, the invoice, okay. The same is going to apply, just like in the case of the GDN, okay. The same applies for the GRN, okay. That you're going to be tracing, okay. The company made a purchase. When was this purchase made? It was made in the month of December. Which date? 29th, okay. When was it received? We received that commodity on the 30th of December, okay. Therefore, we are going to be asking, where is a GRN, okay, for this particular purchase, okay. If the GRN is recorded in the month of January and the purchase was made in the month of December, then of course we do have a cut-off problem, okay, that they need to be recorded in their correct accounting period, okay. That's a key procedure you can carry out with regard to the cutoff, okay. Asking the company to provide you with the GDNs, okay, as well as the GDN, okay, the GDN as well as the GRNs, okay. For the GRNs, they might be a bit confusing. Why? Because you're receiving them from different suppliers, okay. For the GDN, don't forget, you're the one issuing them out, okay. That becomes a bit more straightforward, okay. So it is possible for you to be able to tally the number, okay. What is the last number in the year 2019? The last number was, let's say, number 100. Would imply, therefore, the next number in the year 2020 ought to be equal to 101. Okay, that's a bit easy to tally. Okay. Either way, it's you to confirm as whether the company is recording the purchases as well as the sales, okay, through, of course, tracking the GRNs and the GDNs. Okay, that's on the cutoff. Okay, the next session is on accuracy. Okay, the next session is on accuracy. Simply, we want to ensure that the figures that have been reported, okay, towards the purchases, towards the sales, okay, towards the inventory value at the end of the year, okay, that we have been able to present the accurate figures, okay. Now, one of the way, okay, that you can able to test as whether the company is presenting accurate figures or the accurate information, okay, you can obtain a copy of the inventory listing, okay, and cast it. Don't forget, as I mentioned, term casting, okay, simply means you're trying to add things together, okay, simply adding up, okay. So that's this more or less like an audit term, okay, casting. Casting simply means that you're going to add these together, okay, try to confirm, for example, of the accuracy, okay, and cast it. So you're going to have a copy of the inventory, okay, the inventory listing. Okay, this company has product A, it has B, it has C. What was the sum total of the value of all those inventory of the company? Okay, I think I showed you this yesterday. Okay, but just repeat. Okay, okay, the company, we're going to ask, for example, the client providers. Okay, what is your inventory? You have inventory A, you have inventory B, you have inventory C. What the value of this inventory? The value of this inventory, okay, you can have here, for example, units, okay, and the price per unit. Of course, you're going to have the total value, okay? These are 10 units, these are 5, these are 8. What the value for A, assume it is 10, okay? This is 15, and this is 20. Which imply, therefore, the total value is going to be 100 for A, is going to be equal to 75, and this is going to be equal to 160. Therefore, what should be the total value? Okay, total value ought to be equal to 175 plus 160 to give us 335. Okay, now simply this is called casting. Okay, you're going to ask a company to provide you with the inventory listing. Okay, they simply like inventory listing. So you can decide to cast, okay, to get the sum total of all the inventory. So you can confirm from the figures you've obtained from your own calculation, the recalculation you've done, okay, versus what appears on the inventory listing. Okay, is there any material difference? Okay, of course, the two figures ought to tally. Okay, that's simply one of the ways, okay, that you can assess whether the company is, or this accuracy when the company is reporting their figures. Okay. Another way you can trace, we cast and test the mathematical, okay, test the mathematical extension of quantity multiplied with the price. I think you've just done that, okay. You test whether how the company has obtained, okay, those values of the inventory they do have, okay, quantity or cost times the price, okay, for all the different commodity, okay. You don't have, if the company will have a lot of inventory, okay, which can run into thousands, okay, so you can take a sample. You don't have to do maybe, okay, all of them, okay. So take a sample to assess as whether the figures, okay, are going to be, they're going to tally with what the client has used. But it can be possible, okay, it can be possible. You don't have to do this manually, okay. I think we didn't mention that, okay. You don't have to do this manually. You can use Excel, okay, to help you out, okay. So in case the product, this company has inventory item from number A to, I don't know, inventory number, okay. For example, this company has inventory from number A all the way to inventory number 1000, okay. Now that's, you can't do this manually. It's going to be out of work, okay. Excel can help you to do that, okay. It's really easy, okay. Simply, you're going to be feeding in the formula, okay, and of course, it can also give you the sum total, okay. So therefore, as much as possible, okay, you need to use the CATs, okay, the computer assisted audit technique. Very simple CAT you can use is the use of the Microsoft Excel to help you out when doing the casting, okay. Trace test count back to inventory listing, okay. I think we discussed this, okay, that as an auditor, you can be called test counts, okay. Then what do you do regarding the test count, okay? Regarding the test counts, don't forget you still need to trace the items that you did find in the test count back to the inventory listing, okay. Let me just show you, okay. If, for example, you have done this, so is a company warehouse, okay, made of maybe 4 components, part A, part B, part C, part D. You did your count in part D, okay? Your count was in part D, okay? This is where the count was, okay? When you are doing the test count, okay, you did find item X, you did find item Y, and you did find item Z, okay? Now, this is the inventory listing of the company, okay? Don't forget to say that items that you did find, okay, when you're doing your test count, of course, they ought to appear in the client inventory listing. Now, if you don't find X in the inventory listing here, you don't find it here, then of course that implies therefore there's an issue regarding accuracy, and of course, as well as completeness, okay? If you don't find Y in the client inventory listing, then of course it's a problem, okay? So therefore, the question here, you trace the item you found in the test count back to the client inventory listing, okay, to confirm on completeness as well as on the accuracy, okay. If the entry has adjusted the GL, okay, if the client has made adjustment towards the GL, okay, then of course those adjustments need to be supported by the inventory count amount and the two amount agreed, okay. So because the adjustment need to be supported, okay. If the client has made any adjustment, okay, towards the general ledger, then of course it need to be traced back to the inventory count. In short, it's like doing a reverse, okay, from the test count. Now here is what the client is more or less like doing, okay. So they have made adjustment on their GL, okay. If, for example, they have made adjustment, they have included, okay, for example, item number 3 or 1-3, okay. Therefore, we need to see, okay, this item 3, was it part of the inventory count, for example, okay? Can we trace this item 3, okay, to an inventory count, okay? Whether it's you who did the count or whether it was done by the internal auditor, essentially this item need to appear, okay? So it's like more or less like it's a reverse, because previously you do the count, then you trace it to the inventory listing. Now this is from a GL, okay, back to the inventory count. Okay, it's like the reverse of it. Okay, to confirm as further any adjustment, okay, any adjustment that the client is making towards the inventory balances on the balance sheet, of course, it need to be supported. We need to see those. If we can ask the margin, okay, you did adjustment to the GL, okay, you didn't include item number 3, okay, where is that item, okay, we would want to see it, okay, to ensure there's no fraud, okay, that might be occurring on the inventory account, okay. Where client is using what we call continuous inventory system, okay, we shall mention the different counts the company can have, okay. We have one of them being what we call the continuous inventory system, okay. If the client is using the continuous inventory system, okay, then of course that means therefore the client is not doing a test once in a year, okay. So they can have tests being done maybe every 1 month, okay, or every 3 months. We can plan that for by the end of the year, the company will have done, for example, maybe 5 counts, okay, 10 counts, 12 counts, okay. I'll call a continuous inventory count or inventory system, okay. Now, if that's going to happen, then of course we need to agree the totals to the continuous inventory records using the cuts, okay. So in case since they are very or they are frequent, okay, count that are being done, okay, then of course the best way is to use the cuts, okay. For example, just to share here, okay, if the client does count maybe once, maybe let's say 3 times in a year, okay, to make our analysis easy, okay. So there's count 1, okay, there's count 2, there's count 3, okay. So if in count 1, okay, the client had, let's say, 1,000 item, in count 2, they found, let's say, 300. In count 3, that is maybe at the end of the year, okay, the inventory balance was, let's say, 500, okay. Now you can be able to make a sort of like a reconciliation, okay. If this was the inventory balance the client had beginning of or at the end of that test count 1, okay. Now we can be able to determine, okay, in the next count, that is in the second count, what should be the inventory balance. Look at here, the company during between test 1 and test 2, they have bought inventory, okay. They have sold inventory, okay. So in case we assume there's no in and out, okay, we don't have any write down that occurred during those 2 times, those 2 counts, okay. Then of course we have purchases that were made during the period, okay. Assume they purchased 200, 2,000. Of course there were sales that occurred. Look, this is plus because it's purchase, it is in, okay. Then of course there were sales that occurred during that time period, okay. Therefore, what would you expect to be the sales unit? There was a test count that was done, for example, in the end of the month of maybe April, okay. We found that the inventory ought to be, the inventory 1,000. Between test 1 and test 2, okay, the company bought 2,000 items. Now the question is, assuming we don't have any write down, okay, that occurred during the year, okay, what ought to be the sales figure between test 1 and test 2, or count 1 and count 2? Let me get your ideas. Ashley.
Yes.
What ought to be the sales figure for between test 1 test 2?
3,000.
They ought to be 3,000.
Yes.
Are you sure?
Yeah, you see that there were no sales in between.
Sorry, between test 1 test 2, what was the sales?
You see that there were no sales, but there were 2,000 purchases.
Yes. No, I'm asking about the sales figure. What should be the sales figure between test 1 and test 2?
Sales figure.
Sorry?
Okay, I've not understood. Please repeat.
Okay, so here at the end of test 1, count that was done, okay, assuming it was done at the end of the month of April, we found that this company had 1,000 units. Then in between test 1 and test 2, for example, assuming it was done at the end of the month of August, okay? So at the end of the month of August, a single count was done, okay? The company found that they have 3,000 units there. Between the month of April and the month of May, a purchase of 2,000 was made. Now the question is, therefore, between the month of April and the month of August, how much of units were sold then? You got the question? Ashley? You went away.
Yes.
You got the question?
Yes.
Okay. So how many units of sale were made then?
0.
I can't hear you. You're a bit too close to your mic.
0.
0, of course, it was 0. Okay. Don't forget, in that particular time period, there was 0 units of sale that were made. Okay. There was 0 unit of sale. So if, for example, okay, as an auditor, as you're trying to do this reconciliation, as you're trying to you find that the client has reported, okay, let's, for example, 1,000 units of sale, okay, then of course there's a mistake somewhere. There's an issue somewhere, definitely. Okay. If the client, for example, you did find that the client has reported 1,000 units, that implies, therefore, there is a problem somewhere. Either the inventory count was not done the proper way, or there could be issue regarding the units of purchase reported, or either the sales unit reported. Okay, that's what I mean by that particular point. Okay, that as an auditor, you can be able to tell. Okay, by trying, for example, trying to make a reconciliation. Okay. If the client has very many different items, okay, of course you can't do this manually, okay, so that what do? You go back to the use of the computer-assisted audit technique, okay, to do this reconciliation, okay. I hope it's clear to all of you on that particular point. Okay, so that was on that particular note. Then another note, another procedure. As an auditor, of course, the client is going to prepare what we call the draft financial statement, okay, before, of course, the accounts get published, okay, they're simply referred to as the draft financial statement, okay, and of course, on those drafts, okay, of course, we essentially do expect, okay, that the client will be, okay, having the notes of the financial statement, okay, they must not, okay, it's a must. On the notes of the financial statement, okay, on the notes of the financial statement of this company, have they done their appropriate disclosures? Okay, have they done their appropriate disclosures? Okay, and the information on those disclosure, on those notes, the financial statement. Okay, do we have any problem? Okay, are they accurate? Okay, when it comes to the valuation, have they reported the value correctly? Okay, when it comes, for example, on determination, okay, on the method they are going to use, okay, have they done the disclosure? Okay. So essentially, therefore, can the disclosure, okay, can the users of the financial statement have those figures, for example, okay, have they presented the accurate position of the company with regard to the inventory? Okay, that's a particular point, okay. The notes, the financial statement, the information presented with regard to the financial statement ought to be correct, okay, it need to be accurate. That's on accuracy, okay? Some of the procedures that as an auditor you can use to assess as to whether the information, okay, the issue regarding the inventory balances, okay, all the way from sales as well as purchases is accurate, okay? Hope it's all clear to all of you, okay, with regard to accuracy. Now the next assertion, okay, that you can test as an auditor is on classification and understandability, okay? Classification, of course, is more or less has the inventory classified. Okay, of course, classification again be the farthest can go is going to be three. Okay, if the company is a manufacturing setup, in short, for this company, they do manufacture. For this company, they go manufacturing. Of course, we do expect they'll be having the raw material, they'll be having the work in progress, and of course, they'll be having the finished good. Okay, so in case the company is involved in manufacturing, of course, we ought to see those things. Okay, in the company, on the face of the company, statement of financial position. Okay, on the classification. Okay, the raw material, the work in progress, as well as on the finished good. They need to appear on the face of the SFP. Okay, that's the first thing. The next thing, okay, is of course we need a note need to be attached to those inventory balances, okay, on the work in progress, on the raw material, as well as on the finished good, okay. The main issue that may require, okay, more detail, okay, more information, okay, could be more towards how the company determines, okay, or rather to what extent, for example, okay, is the company work in progress complete, okay, to what extent is the company work in progress complete, okay, is it 90%, is that percent, okay, how did they arrive at those figures, okay, did they use an expert, okay, essentially the company need to explain to the users, okay, in detail, okay, for example, to the extent to which or how do they determine the value of the work in progress. For raw materials, quite straightforward because simply about the invoices, okay. Finished goods, the items are all complete, so you're simply going to go to the standard cost, the standard cost card, okay. For the work in progress, that's where there could be issues, okay. Therefore, in that case, therefore, we ought to expect more disclosure, okay. We ought to expect more disclosure with regard to how the company determine, okay. For example, the extent to which their work in progress is complete. Okay, that's on classification and other stability. Okay, I hope that's all clear also on that with that regard. Okay. That's on the classification and understandability. Next, we discuss on some extracts on ISA 501. Okay, ISA 501 on audit of audit evidence for specific consideration. Okay, with regard to select items. So Karen, you have a question. Karen?
Please go back to that procedure to test the classification. Please.
Oh, classification, okay, there you go. Okay, this is what you needed. You wanted Karen?
Yes.
Okay, you're done. Tell us once you're done.
Yeah. I'm done.
You're done?
Yes.
Ah, okay. Okay, so the next ISA, okay, ISA that more or less can be relevant for inventory, okay, is called ISA 501, audit evidence that is specific consideration for select item. And of course, one of them is the inventory. That's our main concern, okay, on the inventory. Now, in this ISA, okay, it's more or less trying to give us like sort of, okay, what's the best word? Like a guideline, okay, as to how we can carry out the test count, okay, of the guidelines, okay. Actually, let me refer to the ISA, okay. Okay, so that's, let me share my ISA. You can see my ISA. No, there's a time that you cannot see my ISA, so let me just confirm. Samuel.
Yes. Yes.
You can see the ISA clearly. Can you see it?
Yeah, I can see it clearly.
Ah, okay, fair enough. Okay, so this is ISA 500, okay, 51, sorry, okay, ISA 500, 501 on the audit evidence additional consideration for a specific item, okay, and one of the consideration here we're considering is on the inventory count, okay, is on the inventory count, okay. Is on the inventory count, okay. Now, with regard to the inventory count, okay, what do we do as an auditor, okay? With regard to inventory count, let me expand it a bit. So attendance at the physical inventory count. Okay. Now, as an auditor, what do you do? Okay, when it comes to the physical counting of the inventory, as mentioned, don't forget one of the unique procedure. Okay, of course, might not apply to maybe other accounts is on the inventory count. Okay. Now, the actual counting of the inventory of the company. Okay. Now, in note number 5. Okay, in note number 5, I can be able to. Anyway, okay. So in note number 5, when inventory is material, when the inventory is material to the financial statement, the order should obtain sufficient, appropriate audit evidence regarding its existence and condition by attendance at physical inventory counting unless it is impracticable. In short, if the inventory balances are material, okay, to the financial statement, then as an auditor, you should attend the company inventory count. Okay? Don't forget, as I mentioned, don't forget, as an auditor, you don't need to be the one doing the count. Yours is about test counting, okay? Yours is about test counting, okay? As we saw in that particular graphic, okay, where the company has 4 warehouses, okay? You don't have to attend all of them, okay? You just need to take one of them, okay? So out of the 4, for example, you can decide I'll just do a test count in one warehouse, okay? But you need to, okay, you need to ascertain that the company is doing the inventory count, unless it is not possible, unless it's impossible for you to attend the inventory count, okay? And actually, the inventory count, if you still remember, we did some question on the test of control, okay? So always remember, okay? We did some question on test of control, and one of them was on the inventory count, okay? So actually, the inventory count can be used as a test of control as well as a test of detail, okay? So it can be used from both, sides, okay? As a test of control as well as a test of detail, as a substantive audit procedure, okay? So it depends what was the main objective, okay, as an auditor. Was it to ascertain as whether the company controls with regard to the inventory are working? If that was the main intention, if that's therefore a test of control. Are you trying to ascertain whether there's any misstatement on the inventory that becomes therefore a substantive audit procedure? Okay. Of course, you can do them at the same time. Okay, of course, because you don't have time to attend in count now and then. Okay, you may have on once a year, so you can combine the two procedure into one. Okay, into one visit. Now, the attendance, okay, serves as a test of control or a substantive procedure over the inventory. Okay, over the inventory. Such attendance enables the auditor, okay, to inspect the inventory, observe compliance with the operation of the manual procedures for recording, controlling the result of the count, and provide all the evidence as the liability of the manual procedure. I think I mentioned that, okay, that essentially when it comes to the inventory count, when it comes to the attendance of the inventory count, okay, we are simply trying to assess as whether the company, okay, internal control system, okay, is working, okay, as whether the company internal control system is working, okay, the manual directive, okay, the management directive, okay, with regard to the internal control, are they being followed, okay, when it comes to the actual test of control of the company, okay. In note number 6, okay, in note number 6, if unable to attend the physical inventory count on the date plan, okay, due to unforeseen circumstances, the auditor should take or observe some physical count on alternate dates and unnecessarily perform audit procedures on intervening transactions. Okay? If it is not possible, okay, if the count, for example, is being done on 1st of December, okay, if the count is being done on 1st of December, okay, now what does it mean? And you're not available on that 1st of December, okay, don't forget the client is one who doing the count, okay. For you as an auditor, okay, of course you can't, in quote, force a count to be done, okay. So if you remember, as you mentioned at the beginning of the audit engagement, okay, you have to come up with an engagement letter. In the engagement letter, okay, of course you're going to have a discussion, okay, you're going to be asking the management, for example, okay, they need to inform you, okay, when shall you do the inventory count? They can tell you shall do the inventory count on this particular date. Now it's you as an auditor to plan yourself in advance, okay, to attend that inventory count, okay. Now, if the client says that you're going to do the count on 1st of December, on 1st of December you're not available, okay, I see that you have another client, okay, you're attending to, okay, what do you do, okay? If that's the case, therefore, you may have to set another date for yourself now, okay? You can decide, okay, I'll do my test count in absence, in quote, of the client on, let's say, 10th of December, okay? Don't forget, on the 10th of December, maybe, okay, you may not be able to have the assistance, okay, of the client, okay. If it is possible for you to be able to negotiate with the client, okay, tell the client that at this date I will not be available. Is it possible to push it to 10th of December? Okay, then that's be another good way, okay, trying to circumvent the issue. Okay, and of course, I know the client is going to may have a lot of problem, but in case yes, then of course you may have to do the procedure yourself alone. Okay. In point number 7, where tenders is impracticable due to factors such as the nature and the location of the inventory, the audit should consider whether audit procedures provide sufficient, appropriate audit evidence. Don't forget, it does not mean that in case you can't attend the inventory count, okay, that all is gone. Don't forget, there are some other procedures, okay. Don't forget, the inventory count more is going to help you out in determining the existence, okay, of the inventory. It's more towards it's about the existence of the inventory, as well as can use it for completeness, as well as for accuracy, maybe, okay. But essentially, it's more towards the existence. But there's some other procedure you can use, for example, okay, to ascertain whether the inventory they actually do exist. Okay, so in case there's some other procedures you can use, okay, then you don't have to. It's not a must. Okay, it's not like it's a do or die. Okay, situation. No, okay, you can use some other procedures to ascertain whether the company inventory actually do exist. Okay. And one of the way, okay, you can decide, you can more or less try to reconcile, okay. For example, documentation of subsequent sale of specific items acquired or purchased prior to the physical inventory count may provide sufficient audit evidence. Okay. Now, the sale that occur after, okay, the inventory were acquired prior to the inventory count, however, the sale occurred after. Okay. Let me just try to illustrate that point. Okay, so if, for example, the sale, the inventory count occurred on 1st of December 2019, okay, there's a count. You're not able to attend the count, okay? Now what do you do? Okay, this is when the count was done, okay? Okay, one of the procedure that you can use, okay, to ascertain you didn't attend the count on first, okay? However, we want to know, okay, what was the inventory balance as that particular date. Simply, what you can do is that you can ascertain what inventory. Don't forget, here we had inventory. The sale that occurred here, okay, the sale that occurred after the count, but for inventory that were there at the point of count, okay. If the company, for example, in the month of December, okay, they made purchase of, let's say, 100 items, okay, they made sale of, let's say, how many units? They made a sale of, let's say, 250 items. If the items are identical, okay, the items that we have been able, or the company selling, okay, they are identical items. What should be the inventory closing balance at the date of the count? Let me get your feedback. Kami.
Yes.
On the 1st of December, what do you think was the inventory balance?
I'm sorry, can you repeat the illustration?
Okay, the illustration, okay. On the month of December, the company made purchase, okay, you have the inventory, they have the invoices, you have the client has received from supplier, okay, of purchase of 100 items. In the same month of December, they made a sale of 250 items. Now, assuming that all those items are identical, okay, know that they're not diverse products the company is selling, okay, it's just one item, okay, one item. Now, what do you think must have been the inventory balance at the date of the count? The count occurred on 1st of December.
Yeah.
So what do you think was, sorry?
The sale happened in the same day.
Sorry, what happened?
The sale.
No, the sale occurred, assume that this is now that 1st of December. This is that 1st of December, okay? So the sale occurred in the month of December, okay? Whatever day, but it occurred in between, in the month of December, essentially. So what do you think was the inventory at the beginning of the month of December, therefore, at the date of the count?
The beginning was 150.
And of course, it was 150, okay? It was 150 units, okay? Of course, the company cannot sell items from the air. Therefore, they must have been having 150 items beginning of the month of December. Simple that, okay? That's what you can do as an auditor, okay? That's what you can do as an auditor. It's not a must in case you didn't attend the count, okay? In case you're able to attend the count, they're better off, okay? But in case you are not able to attend the count, then use other procedures, okay? That can help you out in determining what was the inventory balance, okay? So that was on point number 7, okay? In case it's not possible, then try to use some other procedures, okay, that can help you out when doing the test count, okay? In point number 8, in planning attendance at the physical inventory count or an alternate procedure, the order should consider, okay? So when doing the count itself, okay, when you're going to be attending the count, okay, don't forget your main work is attendance. You're not the one who is doing the actual counting, okay? I think I mentioned that, okay? And if you're the one who is doing the actual counting, or in case it is the internal auditor who is doing the actual counting, then that's a weakness in the company internal control system, which the main work is to review, okay, as to how the count is done, even for the internal auditor, okay? It's about reviewing how the company internal system, the internal control is about the review, okay? How is the count being done? Now, in planning the attendance, the order should consider the following: the risk of team statement relevant to the inventory, okay? What is the risk associated with this particular inventory? Is it theft by the employee? Is it theft by the management? Is it a scenario where maybe the company inventory is obsolete? Where could there be a misstatement, okay? Assume that you've already done the test of control, assume, okay, that you've already done the test of control, okay, you have been able to not to identify as per se, you have been able to tell with certainty, okay, that the risk of misstatement is high in this particular area. So since, for example, the client has not done inventory count for the last 1 year, then there could be theft of inventory in mass number. If the inventory are very small, okay, if the inventory in themselves, they are very small, okay, they can be put in the employees of the company or even the management, okay, they can steal them without being noticed, okay, they're small in size, okay? And don't forget, get to know, okay, what is the inherent risk? What is the inherent risk on the inventory of this company, okay? What is the inherent risk of the inventory of this company? Then once you get to know that, okay, you have at the end, you become, in quote, like sort of skeptical, okay, where there could be misstatement, okay. So you have a certain set of mindset, okay, where you can concentrate, okay, your procedures on a given area, okay. Don't forget, you need to give more concentration to where there's more risk, okay. The nature of internal control, relevant internal control, I think I already mentioned that, okay? Get to know what internal controls are the client put in place with regard to the inventory, okay? Whether adequate procedures are expected to be established and employ instruction issued for physical inventory count, okay? Don't forget, as mentioned, the main work for you as the external auditor, and even this applies also to the internal auditor, okay, is that for them is about reviewing, okay, how the inventory count is done, okay? If you're going to do the test, if you're going to do the count, it will be on test basis, okay, not the entire count, but on test basis, okay? Now, if that's the case, you need to review, okay, the count instruction, okay, are the count instruction given to the person involved in counting, okay, are they appropriate, okay, are there mistakes, okay, on those particular maybe instruction that the client is giving to the counters, okay. Then also consider the timing of the count, okay, location, as well as in case you do need an expert assistance, okay. There could be instance, especially, okay, where you have, for example, work in progress, okay. In case we have, for example, work in progress, okay. If we have work in progress, we have said that to what extent is this inventory, okay, maybe, to what extent is this work in progress complete? Is it 90%? Is it 100%? Okay, so you may not be able to tell you. You are not an expert, okay, as I mentioned. Don't forget, you're not an expert, okay. If you do require expert opinion, for example, tell you the extent to which this product is complete, okay. If, for example, it's a building, okay, to what extent is this building complete? Okay, you can't be able to tell you as an auditor. Okay, you require an expert to assist you. Okay, in that context, therefore, you need to ask the expert to assist you when it comes, for example, when it comes to the evaluation of the inventory, especially towards the inventory evaluation, the work in progress. Okay, that's why you may require an expert opinion. Okay. Okay. That's on the things you need to consider as an auditor just before the test count. Okay. In point number 9, okay, in point number 9, when the quantities are to be determined by a physical inventory count, and the auditor tests the count, or when the entry operates a perpetual system, I think I mentioned that, okay, perpetual system or a continuous inventory count system, okay, and then attend accounts, okay, one or more times in the year, they would ordinarily observe count procedures and perform test counts, okay. So it makes it easier for you. In case the client has, or in case the client is doing perpetual counting, okay, then it becomes a bit easier for you, because if the client does maybe 4 tests in a year, for sure you can go to plan. You can go to attend at least one of them, okay. But in case the client does count once in a year, then that's where the problem might be, okay. That's where maybe the problem might be, okay. In instance, okay, maybe the scenario here, in instance where the inventory, okay, it's not so easy, okay, to do the count, okay, because there's some inventory where to do the count might be possible. Yeah. In case, for example, the client is involved in mining, okay, mine of maybe, okay, the building stones, okay, how do you do the inventory count? Or your class involved in there's some things that might be a bit hard for test count to be done, okay. Now in that instance, you may want to consider, okay, the extent there is reasonableness, okay, the client did use when doing the count, okay. I don't know whether again to use, how do you measure the inventory count, okay. Is it based on the storage, okay, because you can't do the count, okay. If, for example, the client is involved in I don't know, the items that they are a bit hard to do, okay, to do a physical count is almost close to an impossibility, okay. In that case, therefore, all you need to consider is the extent of reasonableness of the procedure the client used when doing the inventory count, okay. In point number 11, okay, when inventory is treated in several locations, okay, that is, the client has several warehouses, okay, one in Nairobi, one in Mombasa, okay, they're different locations altogether, okay. The owner will consider which location attendance is appropriate. You don't need to attend both of them. Okay, in case the client has a warehouse in Mombasa, one in Nairobi, assuming that the client applies the same procedure throughout the different location, okay, then you don't need to apply. You don't need to attend count in all those locations. Okay, you can do a test count in one of the location. Okay, you need to do a test count in one of the location. Okay. Question. Okay, so in case there's no question, I guess we can take a break, okay? We can take a glass of water. How many minutes do we take? Where's David? David?
Yes.
How many minutes?
15.
15, okay, so you meet at 9:30 therefore, okay? So you can meet at 9:30 therefore, okay? 15 minutes, and we come and continue with the audit of inventory, okay? So see you after 15 minutes. Okay, welcome back. So on the inventory count, as mentioned, essentially, if the warehouses, okay, I think you just mentioned that point number 11, okay, if the client has different warehouse all over, okay, what do you do? Okay, essentially, therefore, don't forget, you do need to maybe attend one of them, okay, so you may not need to attend every single location, okay, you don't attend every single location, okay. So that you can tell one of them, okay, satisfy yourself as whether in that particular location, okay, there's any potential misstatement, okay, that you may think that could be occurring on that particular area, okay. That's more or less towards the inventory count, okay. Now, in point number 11, the auto review manual instructions regarding. Don't forget, I say that here that during the count, okay, during the actual count, okay, as an auditor, you don't need to. You need all your main work, okay, and of course this also applies to the internal auditor. Okay, I think we mentioned that, okay, that your main work is reviewing, okay. First of all, the instruction that the company has come up with, okay, to the counters, the person who are involved in counting of the inventory, is it appropriate? Okay, could there be some loopholes, okay, that might exist that might mean that maybe they can be utilized in the wrong way, okay. So it's upon you as an auditor, okay, and of course, as I mentioned, this extends the internal auditor, okay, to review those count instructions, okay, that the money has given, okay, go through them, okay, assess as whether they can be able to identify maybe even some mistake or some fraud, okay. Now, the auditor should review the instruction regarding the management, regarding first of all, okay, the application of control activities, for example, collection of used stock sheets, okay, counting for unused stock sheets, and count and recount procedure, okay. What does that mean? Essentially, when you do the count, okay, of course you'll be having teams, okay. You're going to have team A, for example, team B, team C. Okay, you're going to have, if for example we have the warehouse made of maybe, okay, 4 sections, okay, section A, section B, section C, and section D, okay. Of course, we would expect, okay, that in each of those sections, okay, there's going to be someone who's going to be responsible, okay. There's a team, there's a count team, okay, responsible for that particular area. And of course, they'll be given documents, okay. So of course, recording for every count they have done, okay. How many items of X have they identified? How many items of B have they identified? How many items of Z have they identified? Okay. So there will be, okay, an inventory count sheet that they shall be given. They shall be given, okay. Okay. Let me just to share my board so that it becomes clear, okay. So you see that you're going to have here, okay, team A, okay, you're going to have team B, okay. C, and of course team D, okay. So of course each of the team is going to have its own, okay, a document, okay, that is going to dictate, okay, what inventory they have found, okay, and of course the quantity, okay, they have found for that particular inventory, okay. So here they're going to, okay, you may have, maybe as a company, okay, you may extract the inventory name, okay, from your inventory listing, okay. We have A, we have B, item C, D, all the way to the last one, okay. But don't forget, we said for the quantity, for the figure ought not to appear, okay. There should be no figure here for the quantity. It's upon the counter, okay, to fill in here, okay. They found 10, they found 9, they found that 4, okay, they found 73, okay. So it's upon them to fill them up, okay. So here we ought not, their figures ought not to appear here, okay. So upon the counters, okay, to fill in these figures, okay. Now you as an auditor, okay, as I mentioned, just to go back to the ISA, okay. So the first thing is the control activity, for example, the collection one used, okay. If, for example, okay, team A, okay, let's go team A, okay, this was their inventory. This was their inventory sheet, okay. This was their inventory sheet that were given, okay. Then of course we need to, at the end of the count, okay. Of course, team A needs to submit its inventory sheet, okay. Team B needs the same, team C, and of course team D. So they all need to submit, okay. If, for example, in team A, okay, team A was given this is a report from team A, okay. They were given, for example, 3 inventory counting sheets, okay. So now they have used one of them. Of course, the other 2 need to be returned. Okay, don't forget, at the time of the issue, okay, we need to assign. Okay, we need to say that. Okay, team A was given in the inventory sheet number 1, 2, number 3. If possible, then you can even name them. Okay, the first one was number 001, for example, 002, 003. Okay, for the sake of accountability. Okay, for the sake of accountability. Now, team B is going to give, for example, from number 004, 005, 006. Okay, the same applies to C and D. Okay, if possible, they should be on a sequential basis. Okay. Now, once the count has been done, you see that the team A has only used the 001. They need to return 002. They need to return 003. Okay. There need to be a reconciliation done at the end of the account. Okay, there need to be a reconciliation done at the end of the account, both used and unused inventory sheets. Okay, that need to be done. Okay, if one of them is missing, of course, there need to be a reason as why maybe one of them is missing. Okay. Okay, that's from point number A. Maybe there could be instance, okay, where there's a recount. Okay, there's a recount. Maybe there's a huge problem. Okay, now where would a recount occur? If, for example, from the inventory listing, okay, if, for example, from the inventory listing, okay, team A, from the count they did here, okay, assume that they have found, for example, that there's 200 items, okay, there are 200 items. But as per the company inventory listing, okay, the company documents, okay, they do dictate that the inventory that ought to be there, for example, is equal to 150. Now here is a material difference, okay, because you have a difference of 50. Now in that case, therefore, there could be, okay, or the management, okay, might sanction a recount, okay. Now if there will be a recount, the same thing apply, okay, that we need to have a reconciliation of this. We need to see where is the reconciliation coming up, okay. So even in the recount, okay, if the team is asked to recount, okay, if possible, don't forget, it should not be the same team. Okay, in an area where there's a recount, if possible, it should not be done with the same team. Okay, maybe you can ask team C need to do the recount, okay, or team D or team B, but not the team A, okay, if possible. Okay, but we ought to have another team doing the recount. Okay, just to assess as whether there maybe team A had issues, okay, whatever in whatever way it is, but essentially, if possible, we ought to have another team doing that recount, okay, altogether. In point number B, accurate identification of the stages of completion of work in progress, of slow-moving, obsolete, damaged items, and of inventory owned by a third party. Okay. Now, if the sum of inventory, okay, and I think I mentioned this yesterday, okay, that we may want to ask the management how they are able to identify, okay, what we refer to as a slow-moving stock. Okay. How is the management able to identify slow-moving stock? Okay. In that case, therefore, you may want to ask them, okay, give us the instruction they did use, okay. How do you identify, okay, the stage of completion, okay, of your inventory, okay. So all these things, okay, it's you as a auditor, you're going to be asking the management, okay, it's an inquiry you're making from the management, okay. Maybe not always a must, okay. If they have an expert, okay, they use an expert to identify, for example, the time of completion of the work in progress, then of course you go back to our criteria, okay, on ISA 610, okay, ISA 620, as well as ISA 4, I can't remember the ISA, okay. But essentially, okay, ISA 500 on the manual expert, okay? So in that case, therefore, you may have to, you have to refer back to the criteria that we mentioned, okay? Says how competent they are, the degree of independence, the degree of subjectivity they may be having, for example, okay? The assumption they have used, so you go back to that criteria, okay? You go back to assessment of the work of this expert now, okay? So how do the manual identify the stage of completion? If they use expert, then of course we go back to the criteria we did discuss under the case of management expert. In point number C, now in regard to that party, okay, just make a mention here, okay, inventory owned by a third party, inventory owned by a third party, okay. If the client has inventory that is owned by a third party, then of course, as we mentioned, what do we do, by the way? In the warehouse, we do have some inventory, okay. It is not our inventory, it belongs to a client, okay. It belongs to another party, okay, but it is in the client warehouse. What should be done there? Let me just to confirm. Delphine.
Oh, gosh. Yes.
You missed class yesterday.
I'll answer. What's the question?
The question is, if we have stock, okay, the company has a warehouse, okay, and some of the items in that warehouse, they belong to a third party. Maybe, for example, the company has made a sale, however, the buyer is yet to come and pick them up.
Yeah.
What should happen in that case when we do the count?
You're not supposed to include it in your account because it's not your inventory. It will overstate your
inventory.
Yeah.
Okay, essentially, therefore, that should also be done. Okay, that essentially, therefore, when doing the count, okay, when doing the count, don't forget the client should have identification. Okay, they need to, for example, segregate that inventory, put that inventory okay, in a separate area. Okay, so that they are not counted. Okay, as part of the client inventory. Okay, so that you don't end up overstating the inventory balances. Okay, thank you, Delphine, for that.
Welcome.
Then where appropriate arrangements are made regarding the movement of inventory between areas and the shipping and the receipt of inventory before and after the cut-off date. The last point we try to tell us that is if you're doing the count on that 1st of December, okay, if you're doing the count, for example, on that 1st of December, okay, you have to be careful the inventory coming in and out of the warehouse during the count, okay. So you have to be quite careful what inventory are coming in, okay, and what inventory are getting out of the warehouse at the date of the count. Okay, you have to take note of those. Okay, the inventory out and in of the warehouse during the count, if possible, if it is possible. Okay, that maybe in quote the process or the production process of the client to stop. Okay, quite hard, but in case of to stop, it will make it work easy. But since it cannot stop, okay, of course we need to take account of the inventory at that particular date. Okay, it becomes a bit more complicated. Okay, because they will be in and out during the count. Okay, but you have to take note of those in and out during the count. Okay, of course, you need to make a reconciliation once the day is over. Okay. Hope it's all clear for all of you. Okay. In point number 13, to obtain evidence that the money control activities are adequately implemented, the auditor would observe employee procedures, perform test count. Okay, I think I mentioned that. Okay, that we do test count. Okay, and the same I think I mentioned it do apply to the internal auditor. Only the test count is about reviewing whether the instructions are being followed and the count is done in the appropriate manner. When performing test count, the auditor performs procedures over both completeness and the accuracy. Okay, test count is more towards on the accuracy of the figures. Okay, that you're going to be reporting, as well as whether the inventory actually do exist. Okay, actually the procedures, the assertion, okay, that we can be able to ascertain, okay, with regard to the test count, okay, is completeness, accuracy, and existence. Okay, those are the assertions that we can be able to test through the test count. Okay. When performing test count, there are performed procedures over both completeness and accuracy of the count records by tracing items selected from those records to the physical inventory, we mentioned. So tracing them back to the documentation. Items selected from the physical inventory to the count records. Okay, so if you are to find that we do this in our test count, okay, in our section D that you're counting, okay, we have found this X, we have found Z, and we have found this. Okay, so you're going to ask, or you may ask, okay, where was or who did this particular count? Okay, let's go back to working. Okay, if for example you have this case, where is it? Just have a new one. Okay, you see that you have this is a client warehouse. Okay, 4 parts: part A, part B, part C, okay, and part D. Your test count is you're doing the test count in part D. Okay, because from your test count you found X, you found Y, and you found Z. Okay, this is what you're doing. This is the audit assessment. Okay, there's the auditor. Okay, for X you found 10 items, you found 9, you found 3 for Z. Then of course you're going to ask, okay, who did the count in part D? Okay, it was done by team D. Okay, I'm just calling team D. Okay, for team D, we are trying to trace. Okay, we would expect, okay, that in the inventory sheet of team D, we are going to find 10 items of Y. If we don't find them, that's a problem. In short, you're trying to say trace the items you've just done, the test count, back to the inventory sheet that was done by the team then. Okay, and of course, the same applies for Y and the same applies for Z. Okay, you need to trace those items back to what the team did. Okay, what the team did in that particular area. Okay. So the auditor should consider, okay, in this point here, the auditor should consider the extent to which copies of such count records need to be retained for subsequent audit procedures and comparison. Okay, it's you to make that judgment. Okay, do you need this record later on? Okay, so it's you to consider that. Okay. Just true, and let me just go. I think the others seem to be. I think there are things that you have already passed through. Okay, so I don't think I need to go through the others. I think for point number 14 on the cutoff, I already mentioned that. Okay. There are also considers cutoff procedures, including details of movement of inventory just prior to, during, and after account, so that accounting for that movement can be checked at a later date. Okay, I think we did mention all that. Okay. In point number 18, I want to discuss on point number 18. Okay. When inventory is under the custody, okay, and control of that party, okay. Now here we have a supplier, okay, who is yet to deliver. Okay, the company has bought the goods, okay, from supplier A. Okay, supplier A is yet to deliver the goods to the company. Okay, so the company has bought good from supplier. Okay, I mean therefore they are part and parcel of their inventory balance. Okay, however, if you have to go to the company warehouse, you can't find them. Why? Because supplier is yet to deliver them. Okay, in that case, therefore, what happened? Okay, what do we do? Okay, the auditor would ordinarily obtain confirmation, okay, from that party as well as the quantity and condition inventory held on behalf of the entity. Okay, so you need to obtain confirmation. I think I mentioned this. Okay, that they're going to be drafting a letter. Okay, and this letter is going to be addressed to. This letter is going to be addressed to the client. Okay, to the third party. Okay, to the supplier. Okay. Don't forget, essentially, the supplier is not going to make a response to you, okay? Because to you, to the supplier, you are a third party, okay? And of course, they're not going to make a response, okay? They're not going to disclose your client information to you because they don't know you, okay? So, of course, the best way you're going to ask the client, okay, to draft a letter, okay? Of course, you're the one who's going to supervise the process, okay? To draft a letter that is addressed to the supplier, okay? And supplier is meant to, with a list of questions, okay? We as management of company A, okay, we would want you, okay, as our supplier, okay, to confirm to our auditor the following matters, okay, the inventory they bought from you, okay, which are yet to deliver, the quantity, maybe, and even the value, okay. The response, okay, from the supplier is not meant to come to the management, okay, it's meant to come to you as the auditor, okay. That's how we do obtain the confirmation, okay. So you draft a letter addressed to the supplier, okay. But the person drafting, okay, is the management. Okay, it is the management of the company you are auditing. Okay, however, the response, okay, is meant to be addressed to you as the auditor. Okay, hope you can see that process. Okay. Now, what do they confirm? What would you want to confirm? Okay, they can be quantity. I think I already mentioned the quantity, as well as maybe the value of those items. The quantity, the value of the items, as well as what is their condition. Okay, of those inventory. Now, depending on the materiality of this inventory, the order will also consider, okay, depending on whether it is material. Assume that it is material, okay, the inventory balance is material. What do you consider? Okay, the integrity and the independence of that party. In this case, the supplier. Okay, is the supplier independent? Okay, is he within control of the management? Okay, does the manager, can we say that he is independent of your client management? Okay, if he's not, then of course the report you get obtained, you may take it with a bit of pinch of salt, more or less. Okay. Observing or arranging for another auditor to observe the Facebook inventory count. So if it is possible, okay, for you to attend the count of the supplier, okay, you're attending the count of the supplier, you're attending the count of the supplier, okay. If that is possible, then go and attend the count, okay. That makes this a bit easier, okay. Go and attend the count, okay. As a client, okay, as you're doing the count, okay, as the client is doing the count, you'll be concerned with your client's inventory, okay. As the supplier, where is the inventory of my client, okay, and you go do the count. Of course, you come and reconcile with your client inventory listing, okay. If that's not possible, then of course you may want to liaise, okay, with the auditor of the supplier, okay, the auditor of supplier, okay, the two of you as auditors of your company and your supplier, you may want to liaise, okay, to ascertain, okay, how the inventory count was done, okay. Then obtain another auditor's report on the adequacy of the third party internal control and ensure the inventory is correctly counted and adequately safeguarded. Okay, so simply get to obtain a report from supplier's auditor, okay, as to how their client, not your client, but their client, okay, internal control system is working. Okay, obtain a report from them. If they're working, then fair enough, you can go ahead and rely on the report the management, okay, are going to give you. Okay, or even what the report, the confirmation you get obtained from this third party, the supplier of your client. Okay. Also, you can also inspect documentation regarding the inventory held by that party. For example, warehouse receipts, obtaining confirmation from other parties, where such inventory has been pledged as a collateral. Okay. In some cases, okay, you're going to mention one of the accounts that we're going to, we did say we shall audit is on cash. Okay, cash at hand, and of course, also audit of bank. Okay. Now, also in the case of bank, okay, you may want to ask the bank some question. The bank of your client, okay, the banker to your client, okay, and one of them is that sometimes you can have a scenario where the client is using their inventory as a collateral. Okay, your client is using their inventory, okay, as a collateral, as security against a loan. Okay, if that is the case, okay, you may want, of course, to go through the loan agreement. Okay, you may want to go through the loan agreement. Okay, is this company has any of the term and condition, okay, not been fulfilled by your client? If it has not been fulfilled by your client, what are the repercussions? Okay, because it might have an impact on the company going concern. Okay, because you can have a case where maybe the bank want to dispose of the client, your client, okay, inventory. Okay, so what is the repercussion of the company going concern? Okay, our main concern now is more towards the inventory value. Okay. If that is the case, therefore, okay, you may want to assess whether that inventory, okay, does it really belong to your client, okay? Because in case they have not fulfilled the terms and obligations, then maybe that inventory, okay, doesn't belong to your client, okay? Anyway, so you may want to assess what are the terms and conditions of the loan agreement, okay? And has the client, for example, fulfilled all those terms and conditions? Okay, that's on ISA 501, okay, on ISA 501, okay? Don't forget to obtain the ISA, simply just go search it, okay? ISA 501, and it's going to give you the ISA. Okay. Question? Okay, I think we've mentioned all the things that I wanted to discuss so far, okay? Maybe just to give a mention on the three systems we have mentioned on the event account, okay? You can have counts be done at the end year. Okay, if the year is counted on that 1st of December, then the count can be done on that 1st of December. Okay, if the count is done, you can also have the count done before or after. Okay, if the year end ends on that 1st of December, the count can be done maybe on 10th of December or 10th of January the following year. Okay, so it can be done either before or after, or at the year end. It can be done on that 1st of December. Okay, or you can have a case where we have called the perpetual invalid account. Okay, we can mention all this. Okay. So those are more the three invalid account methods that a client can apply. Okay, just to illustrate by a graphic. Okay, so see that the year is coming to an end on that 1st of December. Okay, so that 1st of December 2019. So you can have three cases. Okay, you can have the count, okay, being done at this particular day. Okay, it is done at the year end. Okay, then a case where the event count is done before the year end. Okay, so it's done, for example, on 10th of December, or it can be done after the year end. It can be done, for example, on 10th of January the following year, 2020. Okay, so that's another way of doing the count. Or you can have a case where the count is done throughout the year. Okay, it's done throughout the year. Okay, all the way until that 1st of December. Okay, so you can have those three cases. Okay, at the end, before or after, or what we call a perpetual inventory count. Okay, which one is better? Okay, it depends on client. Okay, in case the client is not so busy client, okay, then of course the count can be done any day. Okay, because the client is not so busy. Of course, you have to consider the clients want to minimize the cost, of course. Okay, the count in itself is a cost to the client. Okay. Okay, that's on the very count. Okay, and this is more tries. What do you do? Okay, according to what the case is a perpetual inventory count. Okay, just one note is that essentially it may be done at least once in a year. Okay, the count for sure. Okay, it need to be done at least once in every year. Okay, once every year. Okay, that should be how the count should be done at least once every year. The records of the client are up to date. Okay, and of course they need to be what called test counting. Okay, they need to be test counting. If there's any differences, I think you mentioned, we need to investigate and of course correct any of the differences if those differences are material. Okay, before the count, what happened? Okay, of course you make arrangements. Of course you say that these arrangements are done way before. Okay, you at the point of engagement. Okay, of course you need to ask the client to tell you. Okay, when do you do the count? We do the count of the 10th of January. Then you plan yourself as an auditor. Okay, how you shall be able to attend that inventory count. Okay, so discuss the arrangement with the management. Okay, Of course, assess the key factors. Okay, get to understand, for example, the location, the inherent risk of the inventory. Okay, what is the potential chance of mistake occurring in this inventory? Okay, you mentioned you review the instruction given to the counters. Of course, you need to do that. Okay, and of course, you need to plan the procedures. Okay, where are you going to be doing the count? Okay, do we need an expert? If you need an expert, who is going to pay this expert? Okay, so plan for it in advance. Okay. So during the count, during the actual count, okay, of course, you see that your main work is to observe, okay, observe whether the instruction are being followed by the counters, okay, I think you mentioned that, okay, observe the count being done by the counters well, okay. Then of course we say that you do the test count, okay. Your main work is not easy. You don't do the count you're going to do, okay, is a test count, okay, not a count for every entire section. Is a test count, okay. Ensure the client has procedures of identify slow-moving stock, damaged goods. We can mention that. Okay. Confirm inventory held by that party in whatever way. Okay, through a letter, through asking the auditor. Okay, so whatever way you're going to do. Okay, but at least confirm as whether the inventory your client is saying has held by that party actually do exist. Okay, in whatever way you want to confirm that. Okay. Okay, where the count, the conclude as whether the count was done properly. Okay. If not, of course, you may want to ask the management to do a recount. Okay. If you think that maybe the count was not done properly, you can make a recommendation. Okay. To the management of the company that they need to do a recount on the inventory they've just done. Okay. If any amendments, of course, you need to make those amendments. Okay. And of course, going an overall impression of the level and value of the inventory held, so that the auditor may, in due course, judge whether figures of inventory appear on the financial statement reasonable. Okay, so all these are things that you may want to consider. Okay. Now, after the count has been done, what do you consider? Okay, I think you mentioned this. You trace items that you did find on your test count into the final inventory sheets. I think I mentioned this already. Okay, you need to trace. Okay, we did the count. We found X. So is this X in the final inventory sheets of this company? Okay. Observe whether all the records have been included in the final inventory sheets, and that's why you need to have the different inventory sheets given to the teams, okay, to the count team, okay, with a number, okay, number 1, number 2, number 3. You cannot make a reconciliation. If one of the inventory sheets is not there, then of course you need to ask, okay, why is this particular inventory sheet not available, okay. Then of course, generally, since there are going to be many teams, okay, team A, team B, team C, as well as team D. Okay, of course, at the end of the day, we are going to you combine them into one. Okay, you're going to combine them into one. So you're going to have a final inventory. Of course, it need to tally, okay, the individual inventory sheets. Okay. I think you mentioned this already. Ensure continuous inventory records are adjusted, okay, to the physical amount counted. Okay, mentioned this already. Confirm cutoff. We mentioned this already by the GRNs as well as the GDN. Okay, I think that already you also be able to mention. Okay. I think you mentioned review replies from that party. Okay, you, for example, you have inventory that are held by that party. Okay, check on the report you obtained from them. Okay. Confirm the client's final valuation, okay, is correct. Okay, and mention this essentially, therefore, you're not an expert. So in case you do want to use experts, then of course use experts. Okay. Follow-up queries as well as notify problems to the management. In case you think that maybe, for example, how the count was done was not satisfactory, then of course you may want to tell the management, okay, hey, check here. Then how the inventory count was done was not appropriate. It ought to be done in A, B, C, and D. My recommendation, you need to redo the test count, okay, and you need to do the count, okay, as an entire team, okay. So all these, therefore, it's you as an auditor, okay, to assess. And that's on the inventory count, okay? That's on the inventory count, okay? You didn't mention all this, so I don't need to go through them again. You mentioned valuation, okay? So all these, you didn't mention all these, okay? Cost and NRV, okay? That is for the requirement of IS2, okay? Question? Okay, so that is the audit of inventory, the audit of inventory, okay? If there's no question, yes, coming. Yes, coming.
Can you explain the last point on the ISA about inspecting documents of inventory held by third party?
Okay, let me share the ISA again. Let me know. Is that ISA? Or this last point here, inspect documentation regarding inventory held by the
Yeah.
parties. For example, warehouse receipts, obtain confirmation from other parties when such inventory has been pledged as a collateral. Okay. Now that point, I want. Now, if for example your client, okay, if for example your client, okay, has the bank, okay, the client has used one of your client has used, okay, their inventory as a security, okay, against a loan, okay. That's an example. It implies, therefore, if the client has not fulfilled the terms and obligation of that loan agreement, okay, now what will happen as per the agreement? So more or less, you may want to ask the client, okay, provide me with a loan agreement you had with your bank. Has the client fulfilled all the terms? If not, okay, what does it imply regarding whether the bank can now come and dispose of the client inventory? Okay, because if the company has not yet fulfilled those terms and conditions, it might mean that maybe the bank will take over those inventory. Okay, so as maybe we can ask the bank, for example, okay, what is their plan? Okay, because if they're going to take over the inventory, then should the client report that as part of the inventory balance? No, they have not to do that. Okay, that's only by that particular point. Okay, that
But the
includes,
documents for the
sorry,
third party or the client,
sorry,
the documentation
yes.
for the third party or the client.
All this documentation, okay, so it can be from both parties, okay, it can either be from the client or it can be even from the third party, okay, it can be either from both sides, okay. So it's documentation regarding inventory held by third parties, okay, so it can be either from both sides, either from your side, maybe the client, if for example in the case of a loan agreement, the two of them or the two parties will have that agreement, okay, your client can have the documentation or even third party can have that documentation, for example, okay. Kami, I hope it's clear. I hope it was clear, Kami. I'm not sure. Let me just check. Okay, hope it was clear, Kami. Okay. Yes, so that's more or less, okay, how you do audit, okay, audit of the inventory. Okay, so in case there's no question, then I guess let me check whether there's no question. Okay, so Quinta, you're asking we go back to the slide with activities before the count. Okay, so let me take you back before the count. Okay, what do you need to do before the count? Okay, or simply how do you prepare before the count? Yes, there it is. I hope that's clear. Okay, there you go. Okay, for the others, you can sign the register and we meet tomorrow. So tomorrow we go to the next account, which will be on account of audit of account receivable. Audit of account receivable. See you tomorrow.